What if World War I wasn't just a war fought on muddy trenches and blood-soaked fields, but a conflict ignited and sustained by invisible forces, debts, loans, and balance sheets? What if the real trigger was a financial system spinning out of control under the weight of compound interest and sovereign borrowing? Welcome to the Daily Rebirth. If this changes how you see history, subscribe now. Wars are fought with bullets, planned with balance sheets. Pop quiz. What's more dangerous than a loaded gun? A compounding loan that no one can repay. Compound interest, the financial equivalent of a slow fuse burning beneath empires. Think about that. This is the hidden engine behind empire building, behind alliances, behind mobilizations. It's the sound of interest payments racing faster than revenue growth, of empires borrowing from tomorrow to settle yesterday's debts. And once that spiral begins, governments face a brutal choice: expand faster or collapse faster. War becomes not just a political decision, but a mathematical necessity. Let's rewind and explore how this balance sheet trap exploded into global conflict. Historians debate magnitudes and motives, but the incentives on the balance sheet are plain. By the mid-1870s, about two-thirds of the Osmanlı İmparatorluğu, Ottoman Empire's revenue, went to servicing foreign debts. Ottoman Empire, Osmanlı İmparatorluğu. Imagine your entire paycheck being swallowed by loan repayments, leaving barely a penny for rent or food. The empire was caught in a perfect storm: mounting debt, recurring natural disasters, and a global financial crash in 1873 known as the Panic of 1873. Floods and droughts devastated harvests across Ottoman lands, causing widespread food shortages. Peasants grew restless, and the government struggled to keep order. In desperate attempts to stabilize the economy, the Ottoman government distributed food and increased spending. But without enough tax revenue, it was a losing battle. Political stability eroded as civil servants and soldiers sometimes went unpaid. Ismail Pasha, the Egyptian vassal ruler under the Ottomans, sold his shares of the Suez Canal to Britain. Suez Canal, Suez Canal. Transferring control of a crucial international trade artery to a foreign power. Imagine having to sell your house just to pay yesterday's bills. Here's the kicker: the Ottomans defaulted on their debts. On October 6, 1875, they stopped paying interest on most loans, suspending payments altogether by April 1876. This was no ordinary default. It was among the largest sovereign debt crises to that point, totaling roughly 214 million, tens of billions in today's money. European creditors were outraged. Rather than writing off the debt, the major powers forced the Ottomans to accept a new arrangement. In 1881, the Ottoman Public Debt Administration, the OPDA, was established with sweeping powers. The OPDA was granted authority over about a quarter of Ottoman state revenue, collecting taxes on tobacco, salt, alcohol, fishing, and stamps. Revenue from these taxes was diverted directly to European bondholders. The OPDA was staffed mostly by local officials, but overseen by a council dominated by European creditors, mainly Britain and France. This wasn't just debt collection. It was a loss of sovereignty, a foreign-controlled administration embedded within the Ottoman government. Think about that: a financial watchdog inside your government deciding how much money you keep. The OPDA became a model for financial imperialism, where creditor nations exercised control without brawn or bullets. Meanwhile, the empire's capacity to invest in infrastructure, the military, and social services shrank. European banks, aligned with the OPDA, gained influence over Ottoman economic decisions and investment opportunities. The empire's decline accelerated, losing territory and control under mounting external pressures. These financial constraints also weakened Ottoman diplomacy and military capacity, leaving it vulnerable into the 20th century. The Ottoman default wasn't just a financial event, it was a political and social earthquake. This was the template. So when 1914 arrived, the math was already loaded. The ledgers were primed before the guns. Europe at the dawn of the 20th century looked like a powder keg. But it wasn't just the militaries ready to explode, it was the financial systems underpinning them. Between 1900 and 1914, the great empires built massive war chests. They borrowed billions, running up debts that matched their ambitions. Borrowing wasn't optional, it was mandated by the math of rising interest and growing competition. Let's talk numbers. From 1914 to 1918, the Entente powers borrowed on the order of $16 billion in foreign credit, by some estimates. The United States was the largest creditor, providing roughly $7 billion, mostly to Britain, France, and Italy. Britain itself lent nearly $7 billion, largely to Russia, France, and Italy. France lent over $2 billion, about half to Russia, and smaller amounts to Belgium and others. Here's the kicker. Britain, France, and the US were all both lenders and borrowers simultaneously. But Britain's balance sheet was relatively more balanced. Its debts roughly matched its assets. Pop quiz. Who sat at the top of this credit pyramid? The United States, which did not need to fund itself through external debt until the war. At the bottom, Italy and Russia owed billions and were heavily dependent on loans to keep fighting. France's situation was especially complex. Before the war, French government debt was already about 70% of GDP, among Europe's highest. The new income tax arrived only months before the war began. Much of French wealth was locked in long-term investments in Eastern Europe, funds that could not be quickly accessed or liquidated. When war broke out, France scrambled to borrow extensively. War bonds, treasury bills, national savings, and foreign credit. Starting October 1914, French financiers tapped American markets, first for domestic needs, then to support allies. Italy's finance was a juggling act. Though better off than France initially, Italy lost income streams like remittances and tourism. It depended on British loans and accessed American markets by late 1915. By 1917, much of Italy's food and energy imports were financed by loans from London, Paris, and New York. Inflation hit hard. The lira lost around 40% of its value, making foreign debt costlier to repay. Russia was the financial wildcard. It had long attracted Western investment, especially from France. Russian industrialization fueled a military buildup that heightened tensions with Germany and Austria-Hungary. Ironically, as war dragged on, Russia absorbed more loans. Britain, France, Italy, and the US loaned Russia billions during the war. Anglo-French borrowing on Wall Street for Russia's account was substantial by 1916. Smaller allies like Portugal and Greece also tapped credits from London and Paris, often sourced through New York. These loans kept their armies fighting, tying peripheral nations into the wider imperial contest. By war's end, Portugal owed over $220 million to France. Greece owed roughly $155 million, plus debts to Britain. Wars funded by credit weren't just between two countries. They involved a vast network of lenders, borrowers, beneficiaries, and losers. Think about the scale. Borrowing, spending, and repaying shaped alliances, strategies, and political decisions. Europe's military buildup was mirrored by a financial arms race. Escalating debts and interest burdens forced governments into costly choices. Expansion, militarization, and war weren't just patriotic imperatives. They were dictated by the balance sheets and ledgers governing each nation. Here's the kicker. Financial necessity made war likely, not just possible. Because to avoid financial collapse, empires had to borrow and expand, or risk systemic failure. By 1915, the war had ground into a prolonged and costly stalemate. The Allies were running desperately low on funds for munitions, food, and materials. France and Britain faced mounting bills, while the United States remained officially neutral. But American banks and financiers were quietly preparing to fuel the war effort. Enter J.P. Morgan Jr., heir to one of the world's most powerful banking dynasties. Morgan wasn't just a financier. He was the key node connecting Allied governments with the flow of American money and resources. In early 1915, Morgan was appointed Britain's official purchasing agent in the United States. Morgan's firms handled contracts for vast quantities of war supplies: steel, chemicals, food, explosives. This wasn't mere bookkeeping. This was logistics at national scale. Morgan's export department employed around 175 specialists, processing thousands of contracts worth millions daily. Think about that, millions in goods handled every single day, moving from US factories to European battlefronts. This logistical powerhouse kept Allied armies supplied despite crushing losses and shortages. Then came a historic moment. In September 1915, Britain and France formed the Anglo-French Financial Commission, led by Lord Reading. Their mission was simple and urgent: secure a massive loan from American banks. On September 28th, after intense negotiations in New York, Morgan & Amp Company led a syndicate of roughly 200 banks and investors. They issued a $500 million loan, at the time the largest foreign loan in Wall Street history. Here's the kicker: this loan wasn't charity. It was structured as 5-year bonds at about 5% interest. Private banking corporations controlled the issuance, earning fees and commissions. But the impact was enormous. This loan injected vital liquidity into Allied war budgets. However, the loan carried political weight beyond finance. Morgan's deep ties to the British elite, including his friendship with Britain's ambassador to Washington, Cecil Spring Rice, raised alarms. Critics accused the bank of nudging the United States toward war. President Woodrow Wilson's administration watched warily, concerned about Morgan's outsized influence over foreign policy. This tension kept the US officially neutral longer. Finance eroded that stance line by line. By late 1916, the British government had exhausted its holdings of American securities. It relied heavily on unsecured loans arranged by Morgan. The financial web tightened. Morgan also orchestrated other maneuvers. When the city of New York faced an $80 million bond payment in 1915 that risked embarrassing European holders, Morgan helped organize a $100 million issue. It rescued those assets and shipped gold abroad. To aid France, Morgan's American Foreign Securities Company raised around $100 million by selling gold notes backed by collateral. A clever workaround for neutrality laws that made direct government loans difficult. This mix of financial engineering, syndicate coordination, and diplomacy gave Morgan enormous control over war finance flowing through Wall Street. Between January 1915 and April 1917, Morgan's firms procured over $3 billion of Allied materials. Roughly 60% went to arms and munitions. Morgan wasn't just a bank. It was the war's economic engine. Such scale of financing and material flow would have been unimaginable years prior. But Morgan's role sparked internal US controversies. Some saw Morgan financing a foreign war from American soil, blurring lines between neutrality and engagement. In 1917, when the US entered the war, collaboration between Morgan, government, and the Federal Reserve intensified. Morgan's advisory role alongside the Federal Reserve Bank of New York helped coordinate war bond sales, credit extensions, and procurement. By war's end, Morgan had helped organize upwards of $1.5 billion in loans to Britain alone. The bank's role went beyond finance. Morgan executives led national war committees, advocated Liberty loan drives, and mobilized public support. Liberty bonds gave ordinary Americans a chance to contribute financially. A patriotic investment that created a new war economy. Think about how money transformed from currency to a rallying cry for national duty. But the risks were real. Morgan and investors faced danger that Allied defeat would trigger defaults. That's why the US government later guaranteed repayment, tying American political and financial futures to Allied victory. The $500 million loan of 1915 was more than a milestone. It was a turning point that reshaped global power, finance, and the path to war. Finance didn't follow the war, it steered it. Germany took a different but perilous path. Unable to match Britain's access to wealth and income taxes, Germany faced structural disadvantages. Highly reliant on consumption taxes until 1913-1914, Germany borrowed extensively to finance armaments. Military spending rose over 70% between 1900 and 1914. The Reichsbank extended short-term credits and issued war loans to the public, a proto-monetization of debt. Meaning Germany borrowed from citizens and banks at home, inflating the money supply. Prices rose steadily. Inflation stalked civilians and pressured morale. The government gambled heavily. War would fund itself on reparations from defeated enemies. But interest payments ballooned, making peace an economic imperative no less than political. Germany's debt exploded from roughly 3 billion marks in 1914 to well over 150 billion by 1918. This fueled the hyperinflation and instability of the Weimar Republic era. The United States, by contrast, transitioned from debtor to world's leading creditor by war's end. Federal spending jumped from $477 million in 1916 to over $8 billion by 1918. The Federal Reserve, created in 1913, became Washington's financial engine, managing bond sales, lowering borrowing costs, coordinating banks. War bonds and treasury notes financed over $10 billion in war costs. Millions of Americans financially participated. Liberty loan campaigns enlisted celebrities, youth groups. Personal savings became national power. U.S. national debt rose from $2.9 billion in 1914 to over $25 billion by 1920. A massive economic mobilization. This shift enabled the U.S. to finance its own war and lend to allies, reshaping global economic power post-1918. The complex web of loans and reparations created decades-long cycles. U.S. loans funded German reparations mandated by Treaty of Versailles. Germany paid Britain and France. Britain and France serviced debts to American banks. Looping circuit persisting long after the war. Britain finally paid its war debts by 2006, France by 2009, and Germany by 2010. Think about that timeline. People born generations after the armistice still paid for a 4-year war. The ramifications persist today. Financial mechanisms used to enable war still dictate global economic risk. Digital currencies, central banks, austerity regimes, echo incentives that pushed empires toward conflict a century ago. The crashes of 1929 and 2008 and today's financial anxieties are part of this ongoing story. But here's the hope. The daily rebirth points the way forward. Financial literacy is power over fear. Diversify your savings. Beyond assets, invest in knowledge, community, resilience. Understand incentives in finance, politics, and your own money. Build networks that withstand systemic shocks. When you understand wars as balance sheets, peace begins with economic wisdom. What if your next paycheck is the first step toward freedom? If you're ready to take back control of your life, start with your next paycheck. Subscribe to the Daily Rebirth, where financial wisdom meets freedom.